Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world, and sometimes the numbers tell a story you absolutely do not want to miss when we peek behind the curtain of big companies. Today we are dissecting Employers Holdings Incorporated, or IE as they are known on the stock market, and their latest quarterly report. We will take a close look at their financial health and see if their latest numbers paint a rosy picture or if there are some stormy clouds gathering. Before we dive deep into this report, remember if you love getting straight answers from tough corporate documents, give this video a thumbs up and subscribe. Also join our Discord community linked in the description for more exclusive content and discussions. So Employers Holdings Incorporated, a company operating in the insurance sector, has dropped its quarterly report, and we're here to break it down. They're essentially in the business of workers' compensation insurance for small to medium size businesses. Think of them as the safety net for smaller companies, making sure their employees are covered if they get hurt on the job. A crucial service, but one that comes with a lot of moving parts and risks. Let's start by looking at the company's financial snapshot, the balance sheet, as of the 30th of September 2025. This table tells us what the company owns and what it owes. Total assets stand at a hefty $3.5 billion, a slight dip from December 2024. Liabilities are also substantial at over $2.4 billion. This means the company has a lot of obligations to meet. Now let's talk about the money coming in. For the 3 months ending the 30th of September 2025, net premiums earned were $192.1 million. That is the money they've earned from insurance policies after accounting for things like reinsurance. Compared to the same period last year, that is a nice increase. For the 9-month period, net premiums earned also saw a healthy rise, reaching $573.4 million. This shows a steady flow of business. And this is a big but insurance companies make money by collecting premiums and paying out less in claims. Here is where things get interesting. For the 3 months ending the 30th of September 2025, losses and loss adjustment expenses shot up to a startling $186.6 million. That is a massive jump from $117.7 million in the same period last year. This means they paid out significantly more for claims. For the 9-month period, these expenses also climbed from $343 million to $447.4 million. This surge in claim payouts is a major concern. This rise in claims directly impacted their underwriting results. For the 3 months ending the 30th of September 2025, they reported an underwriting loss of $57.1 million. That is a dramatic shift from just a $0.7 million loss in the prior year's comparable period. For the 9-month period, the underwriting loss widened significantly to $71.8 million from a profit of $7.4 million in the previous year. This essentially means their core insurance business is bleeding money right now. In the insurance world, the combined ratio is a key indicator of profitability. It combines losses and expenses with premiums earned. A ratio below 100% generally means profitability. Here is the jarring part. For the 3 months ending the 30th of September 2025, their combined ratio soared to 129.7%. For the 9-month period, it was 112.5%. Both of these numbers are well over 100%, indicating they are losing money on each policy they underwrite before even considering investment income. Last year, for comparison, their 9-month combined ratio was a healthy 98.7%. This is a huge turnaround in their underwriting performance. Digging a bit deeper into those losses, the report mentions significant prior accident year adverse loss reserve development. This means they had to increase their estimates for claims from past years. For the 3 months ending the 30th of September 2025, they added $37.8 million for this. For the 9-month period, that number jumped to $39.4 million. This is a red flag because it suggests their initial estimates for claims were too low, meaning they are still paying out for old claims more than they planned. Now let's look at the other side of the coin, their investments. For the 3 months ending the 30th of September 2025, net investment income actually decreased slightly by 1.9%. For the 9-month period, it increased by 6.2%. This is likely due to a combination of factors, including lower investment balances and fluctuating yields. However, they did see positive results from their investment activities. Net realized and unrealized gains on investments were $21.2 million for the 3 months and $29.3 million for the 9 months ending the 30th of September 2025. That is a good chunk of money coming from their investment portfolio. This is what is helping to offset some of the losses from their underwriting operations. Let's talk about what is left for the owners, the stockholders' equity. As of the 30th of September 2025, total stockholders' equity stood at $1.039 billion. While this amount is significant, it has decreased from the previous year. This reduction can be a consequence of the company's net losses and other financial activities. Looking at liquidity, their total cash equivalents and restricted cash was $167 million at the end of September 2025. This is up from $68.5 million at the end of 2024, showing an improvement in readily available funds, which is positive for meeting short-term obligations. What is next for the company? In a move that might signal confidence or a desire to boost investor sentiment, the board approved a recapitalization plan on the 29th of October 2025, authorizing a $125 million increase to their existing stock repurchase program. This means they plan to buy back more of their own stock. Now let's put on our investor hats and look at the bigger picture. Employers Holdings Incorporated is facing a significant challenge with its underwriting operations. The sharp increase in losses and lay coupled with the skyrocketing combined ratio paints a concerning picture. It seems their core insurance business is not performing as well as it used to. While their investment income and gains are providing some relief, this might not be enough to cover the underwriting shortfalls in the long run. The fact that they are increasing their stock buyback program could be seen as a signal to the market that management believes the company is undervalued or that they are trying to boost shareholder value. However, it also means they are using capital that could potentially be invested back into the business or held as a buffer for future uncertainties. The increase in prior year adverse loss reserve development is particularly worrying as it suggests a potential underestimation of past liabilities. The company's strategy of focusing on small to medium size businesses is generally sound, but the execution seems to be faltering in the current market environment where claim costs are rising. Looking ahead, the company needs to address the root causes of these increased claims and reserve strengthening. Without a clear plan to improve underwriting profitability, the reliance on investment income could become a precarious position. We will be watching closely to see if they can turn this around. Alright, that is our deep dive into Employers Holdings Incorporated's latest quarterly report. What do you think about these numbers and the company's direction? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more. And don't forget to join our Discord community linked in the description. Thanks for watching, and we will see you in the next episode.